Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for joining us today. Our show today is brought to you by my company, Bull Realty TCN Worldwide. We are brokers in the Southeast U.S., and we have teams in every specialty from senior housing, medical office, self-storage, hotels, office industrial, retail, land. I like to do a lot of REO work. I like to do a lot of office work, which is a good topic for today. Well, it's not our topic today. Our topic today is really the cycle. Where are we? There's always been a lot of investors in my life career here in this industry that sometimes I call them about buying a property in a good market on an upcycle. And they'd laugh and say, Michael, it's so cute you called me and thank you for calling. But we don't buy until it's a bottom of a cycle. I'm like, I know, but I need to call you and stay in touch. So where are we? Are we at the bottom of the cycle? Are we in a recovery? I think it's a big question that we all ask. Well, let's ask an expert. Xander Snyder, he's senior commercial real estate economist of First American, or I like to say of the world. Xander, good to see you.
Good to see you again, Michael.
That's a good question that our listeners and viewers have out there today in the U.S. who are in this crazy commercial real estate world. The economics in the world and in the country seem to be different than they have in the past. It seems to be waving and changing a lot. When we think things are getting better in recovery, then something else happens. And it's like, so where are we today?
Yeah, I think maybe what I can say is I think we're in the beginning of the next commercial real estate cycle. It might be helpful to talk about what a cycle really even is, in case some folks are unfamiliar with the concept. But essentially, commercial real estate is a very cyclical industry. It follows cycles that may not be fully predictable, but they're going to happen, they're going to end, and that new ones are going to begin. And when I think about a business cycle, or specifically the commercial real estate business cycle, I think about sort of the following processes. At the very beginning, you have credit expanding. Prices are driven up as cheaper credit kind of makes it easier for purchase demand to enter the market. Cap rates compress. And that goes on for a while until people realize perhaps that fundamentals don't fully support the prices that are being observed in the market. And this can lead to demand pulling back, prices falling, and then credit can contract, which pushes prices down even further. And the next cycle really begins when prices stabilize enough for more underwriting to make sense, to pencil out. Lending returns, origination increases, but sort of at a lower leverage. So that's typically what a business cycle looks like. And I think as it relates to the commercial real estate industry, we're at the very beginning of the next cycle.
The beginning of the next cycle. So in a recovery?
I think the very early nascent stages of a recovery, yes.
Seeing from the broker view here in the Southeast U.S., we're starting to see more sellers willing to put properties on the market, more buyers excited about buying and closing deals, and actually lenders looking at doing office loans again.
God forbid.
It's crazy. So what out there in the business world and in the economy is impacting this? Because, it's like I thought things were getting better, then there were tariffs. And I thought in the fall things were getting better. The Fed lowered the rate, but the 10-year didn't really come down. Mortgage rates didn't. What should we look at here that's really impacting? Because we know there's cycles, like you mentioned, but we don't know how long or how deep or how high, really.
Exactly. And I think there are a lot of uncertainties that are unknowable. We can't really have with a great degree of certainty. We can't know with a great degree of certainty what interest rates are necessarily going to be in a year, especially on the long end of the yield curve that's even less directly influenced by the Federal Reserve. So when I think about the end of a cycle, I think about prices correcting enough to attract demand back into the market. And I think we have enough data to show us that this is happening. Prices have stabilized for most major asset classes across the country and are either flatlined or increasing gradually on a year-over-year basis. And transaction volume is gradually returning to the market. Not at a very quick pace, but at levels that are higher than the lows that we saw at the beginning of 2024. So purchase demand is increasing. Buyers are cautious, but entering the market again. And I think, I mean, to your point, buyers are selectively looking to deploy capital wherever they can find motivated sellers. So sellers who are willing to part with the property at a price that might really make sense for the buyer, because the seller has other problems that they're trying to solve, be it a high-level corporate reallocation strategy or a fund closing out or inheritance issues. All of those things are drawing buyers back, but they're being really cautious about how they deploy capital because there are so many uncertainties. And I'll add that a lot of this capital is being deployed with a lot less leverage than we saw in the last cycle. So I think that's the data that we have that strongly suggests that we're at the very beginning of the next cycle, even though we have all of these uncertainties outstanding about the cost of debt and trade policies.
Xander, what's different in this cycle than the last cycle or two? It seems like we always think we're going to get an exact replay, but things are quite different, aren't they?
They sure are, and it's challenging, I'll say, for people who are my age. So people under 40. I graduated in 2009, and so most of my professional experience has been in the last cycle, which lasted from roughly, call it 2010 to 2020 or 2021, kind of depending on how you want to date it. But in that last cycle, several things the last cycle was defined by several characteristics. One, interest rates declined for pretty much the entire last cycle and were low for the entire last cycle. Cap rates also declined for basically a decade straight. I mean, over a decade. And what this resulted in was a deal structure that became very familiar, very repeatable, especially in the multifamily world, where you can buy a property, maybe deploy some additional capital to renovate a number of units or the whole property, increase rent. And then by the time you're done with your renovations, maybe to 2 to 3 years in, you can refinance, pull 30-40% of your money out at a lower interest rate. And then when you do finally sell the building, your cap rates have compressed by 50 to 75 basis points. That very well may not be the case in this cycle. Interest rates could go sideways or up. We don't really know, but they're at a 45-year low. So there's not much area it could go further down, right? And cap rates are not fully dependent on interest rates, but they're influenced somewhat by the spread on what you can earn in commercial real estate relative to lower risk assets. And if purchase demand returns to the market slowly, cap rates might not come down for a while. They might plateau and go sideways. So that kills a lot of deal structures that people my age, who only have experience in the last cycle, have become familiar with. So it's one of those times when it's good to know someone who's been through several cycles, who's a little bit older, or just be smart and look at some line charts that go back to the early 80s.
You've done. But I'm not smart. I'm just old. So I was there. I noticed about the last cycle is different. This cycle is, in the last cycle, there was no money. There was no equity, almost seemingly. I remember being at the ICSC Recon in Vegas, and people were hiding in their booths. And if you went by there and knocked on the door, they would like poke out, "You got any cash? Got any money?" "No." "Okay, but you pop back in." It's like, but this time there's plenty of equity. There's plenty of dry powder out there, seemingly not enough distress. But we see the distress. We see the loans, the delinquency seems to be at a pretty high rate at the moment. Where do you think we are on the distress level here?
Yeah, and I think it's important to think about distress when we think about the next cycle, because prices stabilize quicker than distress is fully worked out. And that's just a function of how distress works. If something happens with a loan, you have to go work with your bank or your lender. They might amend and restructure it. They might not. They might require cash and they might require you to deploy additional cash into the property to show that you have skin in the game. But the fact is, there is a lot of distress in the market right now. Delinquency rates are quite high. Certainly in the office space, they're at levels that haven't been seen since post-global financial crisis, double digits. The thing that I think is encouraging is I believe we're pretty close to peak distress, or or at least some sort of plateau of distress where delinquency rates don't continue to rise. And I think this for a couple of reasons. One, as we already mentioned, prices have fallen enough to attract demand back into the market. And even when you look at volume for office properties, they're up year over year. They were for the second quarter, they are for the third quarter. It depends on whether you look at urban office locations or suburban office locations for how much volume has grown, but they're up. So that suggests that demand is coming back into the market, which suggests that prices have fallen enough for office for more deals to make sense. Office has its challenges, but you can make any deal work if you can buy it cheap enough, right? Even if your office property is 30% occupied, if you can buy it for $1, you can make it work. So I think that's part of it. And then if you look at the share of distressed sales as a percentage of all sales, it's increasing, which suggests that some of that distress is gradually being drained out of the market. So even though I like using this bathtub analogy, even though you might have new distress flowing into the tub and the level of the water in the tub is sort of the outstanding level of the stress, your delinquency rates, if the drain opens up, then that level can still decrease. And that drain opening us up is distressed sales returning to the market because buyers can get a cheap enough price. So I think that though it takes longer to work out trouble loans, and though there is still a lot of distress in the market, we're near a plateau, workouts are progressing, and those distressed sales are increasing. So that will gradually begin to drain some of the distress out of the market. And that's why I think we're near peak delinquency
Xander, what would you say to maybe sellers or buyers, but I guess more sellers here, who are waiting for interest rates for the Fed to drop the rate to almost zero again? That's what sellers want to see. They want to see those old cap rates and those old interest rates. What do you say to the sellers who may be waiting for that?
Hate to say it, but I might just say don't hold your breath. I don't think that the environment that prevailed, especially in the last several years before the pandemic, is a normal one. Interest rates were near zero. Depending on the interest rate, and cap rates got to all-time lows in early 2022. And this was due to a combination of very low interest rates. It was due to a shock in the system that led to a surge in housing demand. It was an unusual time. It was not a typical macroeconomic environment if you go back and look at cycles from the last several years. Now, that's what I'd say to sellers, but to buyers, I would say, don't count on cap rate compression and underwrite with more conservative leverage assumptions. And from the seller's perspective, it's helpful to know that buyers who are deploying capital and being selective and doing that are not going to be able to pay as much. So don't anchor your your price expectations as a seller to what you could have gotten in late 2021. It probably isn't coming back anytime soon.
And we're seeing the Fed, drop their rate, maybe another quarter basis points real soon, or maybe it just happened depending on when this show airs. But that doesn't necessarily mean long-term rates and mortgage rates are going to drop enough to. Any drop is good in my mind, but drop enough to really materially change values. Is that what you were thinking?
I think that's right. I think it might help with the margin with certain types of projects, but not substantially, especially if, we're broadly expecting one rate cut this week at the Fed's meeting tomorrow, actually, and probably another one next month, but it's still kind of up in the air. And we have a gap in data, which makes it a little bit harder for the Fed to make its decisions. But the Fed doesn't really directly control long-term interest rates. They control the Fed funds rate, and the Fed funds rate impacts the secured overnight financing rate, or SOFR. And most variable rate loans in commercial real estate have some spread above SOFR. So in that respect, lowering the federal funds rate can directly impact your mortgage. But fixed rate loans are typically priced on some spread above the 10-year. And the Fed can indirectly control longer term interest rates. And there's actually been a lot of discussion recently about the rate of the Fed's balance sheet runoff. And that's essentially how they can impact longer term rates, by buying or selling treasury bonds or mortgage-backed securities. So there might be some slight modifications around the edges in the Fed's balance sheet strategy in the next several weeks, or the next several months rather. But it probably isn't going to make or break your deal. And if you're needing a 1% interest rate cut to make your deal work, you're not underwriting conservatively enough. Buyers deploying capital are finding deals that work with current interest rates and current prices.
And one of the things that you've mentioned that we've seen in past cycles is new supply levels adjusting for the cycles. And it seems to me, if we look at what's different from this one and from previous cycles, we had that run up during COVID of construction cost and supply issues. And then, so that kind of slowed down a lot of new development. And then we saw the interest rate spike. And so that kind of stopped new development. And then if we look at sectors like office, there's been some reports that this year we'll have more demolished or converted than delivered, which hasn't happened in decades. So when we're trying to figure out, Xander, how deep or long a cycle is going, what might be the impact of new supply and what we've seen different this time than we have in the past?
That's a great question. And I will take a minute to speak about office, because I actually kind of think it sticks out a little bit differently than other asset classes right now. At the top of the episode, we talked about how commercial real estate is cyclical, and that just means that it naturally ebbs and flows. These are things that happen in the course of our industry. Now, with office, there was a shock, which was the COVID-19 pandemic and the rise of remote work, that very quickly reduced the need for office space that we have more broadly. That doesn't mean that all offices are bad or that we don't need office space. We just need less of it than we did. So there's been a structural change. It's not cyclical. It happened all at once. So I think that whatever aftershocks we see in office might take longer to work out than some of the other asset classes. But all that said, there's already been a pretty substantial basis reset in office properties nationally on average that is driving transaction volume back up, as you've talked about on the show before. Now, supply more broadly. Retail is interesting because there's been very little supply of retail added to the market over the last 15 years, and this continues to be the case. And that has actually supported fairly robust leasing fundamentals in the retail space over the last year or so. Even with all the store closures that have occurred this year with Joann's and Party City and Big Lots, there's a number of other big name brands. Retail landlords have typically been able to release that space at meaningful leasing spreads, so much higher rent than they were getting before. Now, the near-term oversupply issue, I think, really impacts industrial properties and multifamily properties the most. As you mentioned, when interest rates were very low and when there was a surge in demand for housing and a surge in demand for e-commerce purchasing during the pandemic, we saw multifamily development and industrial development take off. We hit all-time highs of the number of apartment units under construction nationwide and the number or the quantity of industrial space under construction nationwide. Now, as rates have come up and as development costs have gone up because material costs are higher now, starts have fallen for both multifamily properties and industrial properties, which limits the future pipeline of supply coming to market. So right now, we have essentially the market adjusting to all of this new supply. And it really depends on the area that you're in when you're thinking about how oversupplied the market is. I think one of the differences between industrial properties and multifamily properties is that in the long run, we still have a meaningful housing shortage nationwide. So I think the adjustment for the apartment sector, for the multifamily sector, excuse me, will probably not take quite as long. Industrial properties face a unique challenge because they're one of the asset classes in commercial real estate that very well could be directly impacted by some of the trade policies. Because if you have fewer items coming into the ports, you have potentially less need to store those goods in warehouses. Or maybe if, nearshoring really does happen over the next couple of years, the need for warehouses space is still there, but it moves to different parts of the country. So there are really a lot of uncertainties in industrial property right now. And I'll add that most of the new deliveries of industrial space over the last several years have typically been very large properties. They've been larger than historical, and those are exactly the type of properties that tenants are wary of leasing right now because they don't know what their near-term needs are going to be. So we're in a rebalancing process right now in multifamily and industrial, and that will continue to shake out as the beginning of this next cycle.
Xander, where do you think there's opportunities right now where we are in the cycle today?
Well, I do think if you have access to either off-market deals or deals where, like I said earlier, you can get access to a motivated seller that really has a bigger need than just price to sell their property, then I mean, so much money in commercial real estate is made at buying cheaply at the beginning of a new cycle, and that's where we are. You need to be cautious, and unfortunately, you need to basically already have the relationships to be able to access those sorts of deals more often than not. So it will be harder for new entrants into the market, younger folks, to access those deals unless they know someone with those relationships. I think another major theme of this cycle is going to be focusing on operational efficiency. We talked a little bit earlier about some of the interest rate and valuation tailwinds that existed in the last cycle that won't be here this cycle. And all else held equal, that will probably lower returns in the commercial real estate market for the whole cycle. But operations of your building will really be front and center in this cycle, I believe, in part because material costs are much higher than they were pre-pandemic, and certainly repair and maintenance costs have risen more than rents have compared to the fourth quarter of 2019. Insurance premiums have also increased substantially. There's a little bit of pullback in insurance premiums this year and towards the end of 2024, in part due to the increase in the availability of reinsurance capital. But the fact is that climate change is not stopping anytime soon, and that is going to continue to impact insurance premiums. So I think operators that are going to do best in this cycle are really going to be focused on operations. They're going to be focused on limiting expenses wherever possible, making sure that they can get the rent increases that they can really get, but they're not pushing rent so much that they're driving up vacancy. And then, of course, in the last episode that we chatted a lot about some of the efficiency gains that are available from artificial intelligence, be it speed of leasing, be it managing costs at your property. I think there will be really quite an opportunity to benefit your NOI margin from cost efficiencies in this cycle.
One of the things that another thing that seems a little different for me than it has in past cycles is, we're experiencing this down cycle, but for the most part, performance has been great. Except for maybe B office and C office, A minus office. Other than that, all these property types seem to be basically kind of singing along.
I think that's right. I think you could find exceptions. I think that in the multifamily space, a lot of the distress is coming from operators who kind of followed this playbook that I mentioned that existed in the last cycle. But they did in 2021 and 2022, and now they're underwater on their mortgage and they haven't finished their renovation project. And that's not necessarily a sign that you have a bad building. It just means that the operator made mistakes and might lose their equity position. But if you can buy it at 70% of what the prior owner had, you can make it work. I think large property industrial buildings are possibly facing some near-term headwinds because there's so much of that space and there's so much uncertainty about where the need for that industrial space is going to be, that I think that's one of the niches in commercial real estate that's probably facing the most near-term uncertainty. But in the long run, the things that drive demand for industrial property, so the transition to e-commerce, that's not changing. That's continuing gradually. The need for modern logistics space, that's continuing. That's not changing. The need for access to last mile space like industrial outdoor storage, especially infill location that's co-located near where you're actually storing your goods at a warehouse, that's not going to change. So I think that there's going to be a little bit of adjusting within the large box industrial space in the years to come. But 10 years from now, I think it'll be a blip.
Yeah, that's a good point. And I think it might be faster. I could just tell you from our little firm here, regional in the Southeast, we have a million square foot user from another country moving here. We have a couple other very large users and we're helping them with space in the Southeast. And when I look at the office market, when I see the replacement costs are so high and the supply dwindling, I don't know. I think it turns around a little faster than we think, or maybe that's just hopeful broker thinking. Xander, thank you for joining us, sir. We appreciate your insight. Thanks for being with us.
Always a pleasure.
Thank you for listening. Thank you for watching. I'd like to thank our sponsors, TCN Worldwide Real Estate Services. They are our title sponsor. Thank you. If you're looking for commercial real estate services anywhere in the world, check out tcnworldwide.com. Bull Realty, my company for Southeast Regional Real Estate Services. We are Bull Realty, TCN Worldwide affiliate as well. And then Commercial Agent Success Strategies. If you want the ultimate in commercial broker training, check it out. There's 21 videos. And if we can help you, you need a professional for anything in the U.S. or abroad, let us know. My email is an easy one. It's michael@bullrealty.com. Thanks for watching. Until next week, be sure that you always watch, listen, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by TCN Worldwide Real Estate Services, sales, leasing, and property management anywhere in the U.S. Visit tcnworldwide.com. And Commercial Agent Success Strategies, cloud access commercial agent training videos to power your commercial agent business. Visit commercialagentsuccess.com. And Bull Realty, Southeast U.S. Commercial Brokerage Services. Bull Realty, headquartered in Atlanta, is part of TCN Worldwide. Visit bullrealty.com. You're also invited to visit CREshow.com for more show podcasts and videos, and to subscribe to our weekly email announcing the show topic. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.